Hey, what's going on? You know who it is. It is Bruce Jordan, the Michael Jordan Hotels. And today I got Ryan with me. He's going to talk about the top reasons why our loans get denied and what we need to do to get them approved. Today's episode is sponsored by the California Lodge and Investment Conference. Go to clickconnect.com to join me in March, where we're going to prepare for one of the livest conferences. It's definitely my top three, if not my number one. And you'll get to meet me there, and we'll get to have some fun. Ryan, what's going on, buddy? Thank you for joining us.
Not too much. How you doing?
Pretty good, pretty good. I always ask everybody, how did you get started in this business?
Oh man, how did I get started in this business? I got into the business through some friends. So the principals of Arriba Capital, believe it or not, we went to high school together.
Oh wow.
And I was in private equity manufacturing, going through a career change, and they approached me to join the company, and that's history. Yeah,
Nice.
not your typical story in hospitality. Yeah,
So you've been seeing some of this time you've been seeing a lot of loans.
we've been seeing a lot of loans. Yeah.
Tell me about some of the top, like most famous deals that you closed so far.
Oh man. Well, in recent history, we in Texas, especially since that's where we are right now, we've done the Home to True in downtown Houston. We also did the Holiday Inn Express Stay Bridge in downtown Houston, both large scale urban development projects. Right now, we're in the process of closing an autograph collection on Lake Oconee, Georgia. It's going to be the first property to come to Lake Oconee in the last 50 years. So, pretty exciting project. Yeah, and then we finance, everything from small scale, home to suites, trues, Holiday Inn Expresses, up to large scale luxury collection.
What is the biggest deal you've ever done so far?
I think the largest transaction we've done to date has been 90 million, and that was the autograph collection, Lake Oconee.
Oh, 90 million, that's it? Oh, man, I could give you that right now. Here you go. The 90 million, that's a pretty big deal.
It was, yeah, yeah.
Now, like, but the thing with the problem that we're having is a lot of people are having financing issues. So what I want to talk about today is like why the top reasons why these deals get denied. So what's like the number one reason that you're seeing deals?
I'd say the biggest reason, especially as of late, is appraisal values not coming in where they need to be, right? Deal underwrites, it's got a 70%, 75% LTV metric that has to be hit, in some cases lower, and appraisals have been coming in short as of late, right? So that would be the number one reason. That's something clients can't really control, but I think it's good going into a loan process if have an idea of what properties are trading at in the local market, right? Have a pretty good idea of value before you go out for the loan and set realistic expectations.
What are some of the things that they can do to cure that so they don't have those issues going in? Like, should they get their own appraisals beforehand or
I wouldn't say get your own appraisals beforehand, but I'd say definitely have an understanding of where things are trading in the market. Do some due diligence. You kind of always back into a value on your own, whether that's cap rate, price per key, something like that. In a lot of cases, it'll be a metric where not necessarily a loan killer, but a term sheet might say we have to be at a 70% as complete value. And if you knew going in that you're going to need that leverage a little bit higher, it's better to negotiate that on the front end than in the 11th hour and have the loan denied because of it.
now how do banks see the value of a property? Like what are some of the key KPIs that a bank will say, hey, okay, this hotel is worth this. I know appraisal is one of them.
Yeah, I think, every bank's leaning on the appraisal more so than anything, but I think the big metrics you want to look at is, net operating income is what drives hotel values. If you want to back it out and do back of a napkin, valuations yourself to kind of figure out where that's, where your property is valued, I'd say, you want to look at cap rate. What is properties trading for on a cap rate basis in the market, and then price per key. I'd say those are the two big metrics you're really looking at.
Okay, so there's other guys that say, hey, you know what? Since my revenues are this, is 5 times revenue and 10 times revenue.
So we see that on more of the small scale properties. So I'd say like properties where it's sub $15 million valuations. That's a pretty common metric where you'll see a 4x revenue multiplier to kind of back into a value. But I think price per key cap rate is probably a more accurate metric to use.
Okay, but can the bank go either way, or they're just gonna go with?
The bank's going to go off of appraisal, and most appraisals are going to use what they call a discounted cash flow method, as well as sales comps, cap rate. All comes into factor. But yeah, it's the banks are going to lean on appraisals at the end of the day.
Nice, nice. Now, what's number 2? What's the second top reason most loans get denied?
Second top reason is cash flow. Does it service the debt? And I'd say I see that more on properties where maybe you're going through a PIP, right? You're paying off existing debt, you're financing a new PIP, and based on what your performa is, where an appraisal says the performa might end up being versus what you're going to have to service in debt, it doesn't pencil. It's another thing to be prepared for when you're going in for financing, really understand, where the market is, where interest rates would probably land, and back into a debt service coverage ratio or a debt yield to, make sure the project's going to make sense at that new debt load.
What are some of the things they could do to make sure they don't have that issue when the on the P&L or in the financials, it can't service the debt? Do they need to wait a little bit longer till things start to align, or
Yeah, I'd say that's the big thing, right? If you're going out for financing and it's not going to service the debt that you're going out and requesting, I'd say more than anything, you don't want to do that deal, right? And get in the situation where you're going to be tight on cash flow. So it's really doing the work on the front end, doing a pro forma, modeling out the scenarios on the debt side and seeing, is this deal feasible for this debt load? Does this make sense for us to go finance right now?
now, what is the difference between recourse and non-recourse? Can you explain recourse and non-recourse for everyone?
Yeah, it comes down to personal guarantees, right? So with recourse, you're providing a personal guarantee behind that loan. A non-recourse, outside of certain provisions, there is no personal guarantee. So in the event of a foreclosure on the property, in non-recourse, the lender is going to get the keys back to the hotel, take over the asset, but they can't come after you personally for that liability. Whereas recourse, everything that you own is liable and they can come after you on a personal level. Also comes into play if you're doing a lot of construction loans or a lot of development deals. I'd say banks want to see that you have a lower contingent liabilities, meaning you don't have a lot of personal recourse out there. So it's always good if you're in growth mode and doing more development, acquiring new assets, to keep those contingent liabilities as low as possible.
And what are some of the things we could do to make sure we get a non-recourse one?
Not recourse. You've got certain buckets of capital, like CMBS is a popular avenue where that's all non-recourse. Private debt funds on construction deals are typically non-recourse. Life insurance companies are non-recourse, and banks will offer non-recourse in some cases. You typically have to be lower leverage for the bank to offer non-recourse.
Nice,
Yeah.
nice. Now, what's the third reason why these loans are getting denied?
Third reason is deals not penciling, right? Like I'd say on like the construction side, and I know we kind of just touched on that a little bit on the refis. It's, a combination of, cost per key, development costs are very high right now. And most banks, just like on an appraisal, when they're doing banks are always doing an appraisal, but typically require a feasibility study as well in construction. And you look at where costs are, where interest rates are to make a deal pencil. It's challenging. That's the third reason. We're seeing a lot of deals that just don't pencil, can't support the debt load, where, they need the higher leverage. Maybe they don't have all the equity in place, and at that higher leverage point, the deal doesn't underwrite well, right? So the banks can't get comfortable with the risk profile of the transaction.
You hear a lot of people talk about cash out refis.
Yeah.
Can you explain what is a cash out refi? What will we need to get a cash out
Yeah.
refi, and what's the usual amounts that we could get percentages wise?
I don't think there's a usual amount on percentage wise. What is a cash out refi? You're refinancing your existing debt, plus you're taking cash out on top of that, right? And that cash is being distributed to yourself and your investors, essentially. Banks and lenders in general want what they call skin in the game, right? They still want you to have equity dollars that you put in at the beginning of the deal into the deal. And that's a challenge a lot of people have, especially on, fresher acquisitions where, an example would be you acquired a home 2 suites 3 years ago. You did a great improvement on operations. You grew net operating income 25%, maybe increased the value of the property. That's about $5 million, just throwing a number out there. Now you want to go do a cash out refi, pull the 5 million out. Maybe you had 5 million in the deal. When you do that, all of your equity is out now. So now you're kind of playing with house money, right?
Okay.
And that's what banks don't like seeing. They like seeing that you got skin in the game. You still have your dollars at risk. And in their eyes, they feel like you're more motivated to operate the property more efficiently. So that's a challenge we commonly see.
I had took this property. It was a little small hotel. It sold for like 1.2 million. The revenues were like $600,000. I came in. It took me a year to double the revenues. First, I got it.
Which is still very impressive.
Yeah, that's my things. So I doubled the numbers, which is what I usually always do. And when they went to go cash out refund, they were like, no, like we're not going to do it because
Yeah, and you see that more on regional local bank level than you do in other sources of capital. Like CMBS is probably the best avenue to get cash out.
okay,
Right? Because they don't really have the same limitations of viewing skin in the game on the equity side. They're just underwriting to a metric. So if it hits a certain debt yield, debt service coverage ratio, you'll get that loan amount. So that's one way to solve that problem.
okay. So the investors was like, we're just gonna sell it. They sold it for 3 million.
Right. Yeah. That's the other idea.
They're like, forget it. We're just gonna get our money back this way.
Right.
So, but hey, listen, is there anything like, especially when it comes to qualifications, credit score, business credit score, like what are some of the things we need to look out for?
I think credit score I don't really see as a factor unless you're doing much smaller balance local deals. What I think you want to look at is if you're going out for a loan, be prepared, right? Have an idea where values are, have a good idea where your property is going to value, underwrite the deal, make sure you could service your debt. Another factor people don't think of a lot is they want to see balance sheet behind it on recourse loans. So if you're going out for a $10 million loan, typically the banks want to see a net worth on the guarantors equal to that loan amount,
Oh wow.
right? And they want to see liquidity on hand. So if you're going out for a $10 million loan and you've got $50,000 in the bank of liquidity, it's probably going to be challenging to go get that loan. They're going to want to see some more cash on hand.
Is there a certain reserve amount that they're looking for, or
Typically, the rule of thumb is 10% of the loan amount in liquid assets.
okay, okay, and it could be anything. You could do
It
stocks.
could be marketable securities, cash in the bank. Yeah.
Okay, fantastic, fantastic. Listen, thank you. This was a very educational, very educational.
You got some dense questions. Yes, everybody didn't bore you. Yeah.
No, because they need to know. Like, there a lot of people are ready to move into the hotel business, and they don't know the finance part of it.
Yeah.
So that's why whenever I get a finance guy here, I'm like, all right, this. What do they need? Like, we got to create a finance course just for hotels.
There you go.
But tell everybody how they get in touch with you.
Yeah. So Ryan Bosch, Arriba Capital, go on our website, arribacapital.com, look at us out. My contact information is there. And I'd tell you, if you're ever looking for advice on financing for a hotel, reach out to me, any of the team members, happy to offer that for free.
All right, and thank you for joining us for another episode. This is Bruce Jordan, the Michael Jordan Hotels, signing out. This episode was brought to you by the Hotel Revenue Bible, the #1 hotel revenue book that has ever been written. It includes revenue management, digital ads, social media marketing, sales, catering, F&B, and more. Grab your copy today at hotelrevenuebible.com.